Imagine standing on a cliff edge, looking down at a storm building in the ocean. The waves are getting higher, the wind is howling louder, and you know something massive is about to hit. That's exactly where Wall Street short sellers stand right now, staring straight into a liquidity crunch that could wipe them out. They are running out of collateral, they are juggling margin calls, and every move they make is like patching holes in a sinking ship. Today, we're breaking down why this matters for AMC for the broader market and why retail investors see this as the setup of a lifetime. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But everyone, remember, this is not a financial advice video. Now let's begin with what's happening in the AMC community itself. Across social media, investors continue to share proof that the so-called apes are still buying and holding. One user proudly posted a screenshot showing their AMC share count creeping toward 10,000, with today's new total hitting over 1,600 shares. Another user mentioned that every single day they add more stock in honor of the community's long fight, over 4.5 years, standing together against market manipulation. This isn't just talk. These posts are the raw, unfiltered evidence that retail investors haven't left. In fact, they're doubling down. Why is this important? Because the data we're given from institutions is not trustworthy. Failures to deliver, also known as FTDs, can be reset and rolled over, meaning the official numbers rarely reflect reality. Short interest is self-reported, so when hedge funds tell regulators how much they're short, we're basically relying on their honesty. And as history shows, honesty is not their strong suit. Even dark pool data, those hidden trading venues where so much AMC action takes place, is a shadow of the real activity. We know for certain that what we're being shown is the minimum, not the full story. So when you strip away the noise and focus on what can't be faked, you find retail investors still buying, still holding, still united. That's the foundation of this fight. But while retail keeps accumulating, the other side of the equation is getting crushed under its own weight. Hedge funds and institutions built their positions with extreme leverage, counting on endless liquidity. And now, the cracks are showing. Ken Griffin recently tried to calm markets by saying the U.S. economy is doing well, but analysts quickly pointed out his firm's heavy exposure to the Japanese yen carry trade. Here's the problem. If Japanese rates rise while U.S. rates fall, those trades flip from profitable to catastrophic, triggering margin calls and draining liquidity across the market. This isn't just Citadel's problem, though. They are deeply tied to it. It's a systemic issue that could ripple through countless institutions. Think about what that means. For years, critics warned about too much leverage, too much exposure, and not enough cash on hand to cover the risks. On the surface, everything looks fine, until suddenly it doesn't. A small shift in interest rates, a dip in collateral values, or even a rumor spreading through markets can snowball into forced liquidations. That's what margin calls are, forced sales to cover positions when the money isn't there. And we are entering the exact environment where this chain reaction is not just possible, but increasingly likely. Meanwhile, banks are doing their best to mask the stress. Reverse repo data at the Federal Reserve shows cash parked on the sidelines, ticking upward toward quarter end. That might sound like stability, but it's really just window dressing, a way to make the financial system look healthier for regulators' snapshots. Let's put this into perspective. At one point, reverse repo usage climbed as high as $2.4 trillion. Today's moves in the tens of billions sound big, but they're drops compared to the ocean of liquidity that already drained away. It's a temporary bandage, not a cure. And here's another trick they use. When banks release earnings, they often close their winning positions while keeping losing trades open. On paper, that makes them look profitable. But in reality, those unclosed losses are like a ticking time bomb. It's accounting games designed to give the illusion of strength when the foundation is crumbling. Now zoom out to the entire stock market. The Buffett indicator, which compares the value of the stock market to the size of the economy, recently hit 220%. That means the market is valued at more than twice the U.S. economy. For context, during the dot-com bubble peak, the indicator wasn't even that high. Add in the hype around artificial intelligence fueling already stretched valuations, and you see why so many experts are warning about a bubble. One small pinprick, and the inflated market could deflate violently. And remember, short sellers depend on rising markets to keep financing their trades. If collateral values collapse, so do their short positions. Let's not forget the recession warnings popping up everywhere. Heavy truck sales in the U.S. just fell to their lowest levels since 2020, a classic red flag for slowing economic activity. When goods stop moving, economies slow down. On their own, these numbers might not be earth-shattering, but stacked on top of everything else, interest rate shifts, liquidity drying up, overvalued equities, they paint a picture of fragility. Institutions need a strong, rising market to survive. Without it, their entire strategy crumbles. Even regulators are stepping in, and not in ways that help retail. FINRA recently adjusted rules around margin requirements. Previously, traders needed a minimum of $25,000 in equity to access certain types of trades. Now, instead of a fixed threshold, brokers can allow intraday leverage based on positions taken during the day. Sounds technical, but here's the bottom line. This gives institutions and brokers more flexibility to squeeze extra liquidity out of retail investors. The $25,000 rule never bothered hedge funds managing billions, but it did constrain retail. By loosening it, regulators are essentially handing Wall Street another lifeline at the expense of ordinary traders. All of this circles back to one point. Shorts are desperate for liquidity. They need collateral, they need markets propped up, and they need retail's money funneled in to keep the game going. But the truth is clear, the foundation is breaking. From yen carry trades to reverse repo declines, from inflated valuations to recession signals, the system is flashing warning lights everywhere. And here's where AMC and GME come into play. For years, these stocks have been suppressed through short selling, synthetic shares, and hidden trading in dark pools. The only way hedge funds maintained this pressure was by leaning on a market awash in easy money. That era is ending. With liquidity evaporating and margin calls looming, short sellers are staring down a future where they can't keep their positions afloat. And when that happens, when forced covering begins, it triggers exactly what retail investors have been waiting for, the squeeze. So as we stand here today, remember this: the fight isn't over. The data might be rigged, the headlines might be biased, and the institutions might be scrambling to buy time. But the truth is written between the lines. Retail is still here, still buying, still united. Shorts are running out of room, running out of tricks, and running out of liquidity. The storm is coming, and once it hits, the balance of power in these markets could shift in ways Wall Street never saw coming. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Before ending the video, I want to say one important thing. If you have watched the video till this point, it means you are among those who are true AMC supporters. And for supporters like you, we have created a Facebook group. You'll find the link below. Join the group and become a part of our community. Also, for our community members, we have a PDF book inside the group that explains how to do stock analysis. After reading it, you will become an expert in fundamental analysis. Thank you for watching.